The market's focus will now turn to employment data after passing all central banks meeting this week. Analysts expect U.S. non-farm payroll to show 111,000 job growth in September, up from August's 96,000. Unemployment rate is expected to rise from 8.1% to 8.2%. Looking at the leading indicators, a DP employment report was okay at 162,000 even though it dropped from 189,000 in August. ISM manufacturing employment made an impressive improvement from 51.6 to 54.7. But the ISM services employment deteriorated from 53.8 to 51.1. The 4-week moving average of initial jobless claims was slightly up from 371,000 to 375,000. The overall picture suggests that the non-farm payroll won't give much surprise. And, as the Fed has now adopted open-ended quantitative easing which ties to the unemployment condition, today's data should not do much to change markets' expectation of the Fed's program. Canada will also release job data and is expected to show growth of 15,000 in September with the unemployment rate unchanged at 7.3%. The Bank of Japan left rates unchanged near 0% as widely expected. The asset purchase program was also held unchanged at 55 trillion yen. The central bank noted that Japan's economy is, more or less, leveling off. That compared to last month's description that the pickup in economic activity has come to a pause. The bank said it would keep policy unchanged for now and pledged to continue asset purchases and other powerful monetary easing to spur growth. In a rare act, Economics Minister Seiji Mihara attended the rate review meeting during the bank to pursue powerful monetary easing to achieve its price target. The September Federal Open Market Committee meeting minutes gave reasons on the Fed's decision to announce QE3 last month. While little news was delivered, the minutes unveiled that policymakers had a vigorous discussion about shifting from calendar date-based policy targets toward data-driven thresholds. The members also debated on means to reach an economic forecast consensus. The mechanism, upon completion, would replace the current method that each of the 19 members makes forecasts on his own. While the pace and timing of asset purchases remained unknown, it's expected that QE3 will be continued for at least 2 years until policymakers see an improvement in the job market. As expected, the October European Central Bank meeting was a non-event. Policymakers decided to leave interest rates unchanged while little surprise was heard from the press conference. President Draghi also stated that there was no discussion about cutting the policy rates at the meeting, reinforcing our view that the central bank would leave interest rates unchanged till the year-end. The press conference was focused on the OMT and Draghi reiterated that the ECB will give no view on bond yields. Also, the ECB will not purchase Irish or Portuguese bonds until they have regained full market access. The President also indicated that activation of the OMT will be determined by the governments. Many viewed his comments as a call for Spain and the Eurogroup to activate a European Stability Mechanism program.